So Lemonade reported early this morning around 6 a.m. I think they posted their earnings report. It was unusual, but they had a lot to be proud of in there. So I think one of the things that stuck out most to me was just this chart at the beginning. Here, let me bring this up here. So this is just a quarterly kind of look at some of the most important metrics that they have. So you've got their in-force premium year-over-year growth rate. So you can see not only is it growing, but the rate at which it's growing is actually accelerating. So you're going from 18% year-over-year growth to like the 20s, then to 29% in this most recent quarter. So this is obviously just a reflection of the fact that they're spending more on growth spend, but also I think this quarter we got a pretty nice boost from car expanding. Then loss ratio, which what you think about it is like the inverse of your gross margin. So you want that number to be coming down, and just very steady progression. So you got two trends there going in the right direction. And then putting it all together with a bit of an income statement chart at the bottom here, you can see the in-force premium growing. It's not quite doubled, but getting close to doubling in just 2 years. And this is the thing that blows my mind. The operating expense less the growth, so what they're spending on new customer acquisition, is actually down 7 million when you look at Q2 of this year compared to Q3 of 2 years ago or 3 years ago. Like, this is core to our thesis in the company, is that you got some double exponentials on the revenue side, but then because they're leaning so heavily into AI, not just on pricing and their customer facing capabilities, but they're turning AI inward and saying, as an organization, how should we be structured to take advantage of AI? And so that's what's enabling them to support this crazy top line growth that they have while actually stripping out costs.
Mm-hmm. Yeah, a lot of the people that interact with us, they're engineers, they're salespeople, consultants, there's some small business owners. And what you want to see in any business is leverage. You want to see your costs controlled and your revenue and profits growing faster than your costs are growing. Essentially, costs are flat, and over 2 years, the revenues are up at 80%. Or 3 years. Still, it's very impressive, and that's exactly what you want to see in a business. And it verifies the story that Lemonade tells, is they're making an autonomous insurance company, or highly automated.
Yeah, on their investor deck, they basically show the premium per customer that they had a couple of years ago to where it is now. They just crossed $400 of premium per customer. The US average is about 10x higher than that. So it's about $4,000. If you just think of the kind of bundling that's happening where you're going from these beginning of life or beginning of adult life cohorts of customers that maybe are just dabbling in renter's insurance and they've got a pet. So very small dollars that they're actually insuring, or at least paying to Lemonade with premium. As you all of a sudden added a car, okay, that might be $1,800 a year. You add in home, all right, maybe that's $1,000 a year, something like that. So then all of a sudden, just by nature of these cohorts aging up, you might just 10x your business just on the bundling that's going to happen as your customers naturally go a bit older. So this isn't exactly the chart. It does show the premium per customer increasing from 360 to 402. But there's another one where it actually shows the US average at about 4,000. When you look at the kind of all the different areas of blue sky that Lemonade has in front of their blue ocean that Lemonade has in front of them, it's their premium per customer getting to US average levels. It's them being like nobody in the car insurance business. And then just thinking of all the revenue growth that they have while keeping operating expenses flat-ish. I mean, that's why we get so excited about this company.
Now, I might be overstating things, but essentially, Lemonade all but stopped writing car insurance. They greatly scaled things down from their metro.
Do you mean home?
No, I feel like car, they greatly scaled that down. I could be wrong.
They did for a while, but they're expanding now into Colorado and Indiana. So I think they're leaning heavy on the growth now.
Right. So they essentially they relaunched their car insurance offering. And the big question was, can they do so profitably and with low loss ratios? And what they're showing now today is that they've gotten that loss ratio down to 82%. Still a little room for improvement, but now they can profitably write car insurance while they quickly expand it. And they're very excited about Colorado, how profitable it's been for them right away. Yeah, that's my translation of what they were saying.
Yeah.
And I think the expectation is that Indiana is going to be the same. So they've essentially, I believe, figured out car insurance. So that was incredibly bullish. Also, what they'd done with Loco in Europe and being able to handle multiple lines and multiple countries, have it automate a lot of that business. It's allowing them to quickly expand. For me, Matt, what's impressive about that premium per customer is it's still growing despite them quickly growing their European business where the premiums are
Right.
lower per customer.
Yeah. So for those who are not as in the lemonade weeds as you and I are, what is Loco and why is it so exciting?
I think it stands for Lemonade Core. And I want to do a video about Lemonade Core with you, Matt. How's that sound?
I'm available.
Okay. And what it does is it takes all their experience in insurance. They've been doing this for 10 years. They've been gathering a lot of data. They've had to do a lot of regulatory filings, changing prices, and adapt to how to price insurance. And Loco essentially handles a lot of that for them. So it's highly automated. It makes adjustments, and they can really lean on it. So it's not like totally autonomous where like Andre Carpathy could go on vacation at Tesla or whatever, but
it's in the spirit automated. Of Project Vacation, let's say.
Yeah. Their headcount, though, did increase slightly this past quarter. I think it grew by 6%, but the revenues grew by 29%. And that headcount increase was over the last 12 months.
Yeah, putting this all together, going back to the Lemonade thesis, with everything they're able to automate, it does a couple different things. Obviously, as like investing in finance nerds, we love that it really makes for a lot of operating leverage, which is going to create a lot of earnings. But they're extremely focused on doing it in a way that doesn't compromise the customer experience. So they are paying more than 50% of their claims in under, I think it's under 1 second or under 3 seconds, something like that, more or less instantaneously with zero human involvement. So obviously that eliminates cost if you're not having to pay an adjuster to look at every single claim. But on top of that, not getting stuck in the rigmarole of 3 weeks trying to get a call back from your claims adjuster, that just does great things for your customer satisfaction. And if you look at their ratings on the App Store, Lemonade is rated 5 stars because they're delighting customers. It almost seems like impossible to delight a customer with an insurance experience. It's like
with an AI experience
you need, but like you don't really care about too much. Their business model, I think, is just so impressive, and we're getting pretty close now. They were talking about adjusted EBITDA positive by the end of next year, which their adjusted EBITDA is actually extremely close to their net income. So we're basically talking about net income profitability in 2027. It's pulled up a little bit from where I thought they'd be, to be honest with you. And what gets me so excited, though, is they're going to be running at, what is it, a minus 130 million of adjusted EBITDA or something like that this year. So they're going from that to break even in 1 year. Well, what's it going to look like after that? That's why they call it the period where they break into positive net income territory, the fun zone in their presentations, because this train doesn't stop. Like all of a sudden, okay, you continue to have these double exponentials on your revenue side while having linear operating expense growth. And when you just do some simple math on what that means to earnings per share growth, you get to break even. And then very quickly, you're in like multiple dollars of earnings per share and growing at 50% plus rate for a very long time, at least as we're modeling it. I think that will be a very fun zone indeed. And I'm definitely looking forward to being a shareholder during those times.
They also talked again about new types of insurance. So you have telematics for the new car customers. You could easily insure someone's phone. So if you notice through telematics that they're not dropping the phone and that the forces on the phone are reasonable or whatever, they could offer them phone insurance that's independent of the phone manufacturer's white label insurance. You could also do trip insurance too.
Most people don't realize just how big the insurance market is. It's something like 15% of global GDP, or something like that, which is just insane. So you're talking about a TAM
that's over 10 trillion in annual revenue. And I believe as a single industry, it's the largest. It's allegedly larger than manufacturing.
Yeah, larger than manufacturing. It's like larger than this data center boom that everyone is so excited about right now. So this is, as Daniel likes to say, a prize that's worth going after. Maybe it's not the sexiest of industries. I would agree with that, but it's a necessary product and it is an absolutely massive TAM. And frankly, it's one that's ripe for disruption. Of all the different industries that should be heavily automated and reliant on AI, I think insurance is actually like the best one because so much of it is just probabilistic assessments of risk and then automating payouts of those things if a binary outcome has happened. So either you have a valid claim or you don't. And if you do, then you pay it. The logic of it is actually pretty straightforward. And so turning AI loose on that problem is, I think, going to be extremely profitable for Lemonade.
Yeah, it definitely needs to be done in an ethical way. United Health is accused of using AI and denying health insurance claims at a high rate, and they got in trouble for that. But where you could do it ethically with AI, and so people understand, a lot of what Lemonade does is they use AI to funnel intent or the context down into what is the intended thing that's happening, and then from there they use that to bring it through their system. But they also have machine learning models and big data that they're using as well. They talked about the expansion in Colorado and how they were able to cross-sell people right away, or had the biggest in cross-selling results, even bigger than Lemonade's Illinois cross-selling.
Yeah, which is a huge, it's like free cross-selling that you get. If you're a Lemonade customer, so like here in Michigan, for example, they don't offer car insurance yet. If you're just a renter's insurance customer here in Michigan, let's say you're paying, I don't know, $200 a year for your premium, and you're just waiting for Lemonade to offer car, all of a sudden you can go from paying $200 just for renters to paying $2,000 a year for renters plus car. And so like Lemonade, like basically for free, just for the cost of sending an email in these new geographies where they're expanding, can pick up a very serious kind of 10x revenue opportunity within at least a cohort of their customers that's going to opt to this cross-selling. This is they're in the very early stages of doing this now in the US, and it's something that's going to be driving their growth pretty consistently, I think, for a long time. So this was definitely, I think this was the first time I looked at their in-force premium, and it was so drastically above their guide that it was kind of like a noticeable bump relative to how they've done historically. A lot of times they get accused of sandbagging their guidance a little bit. So they'll give a kind of narrow window and then they'll beat it by, I don't know, like $6 million or something like that. And this time they kind of absolutely blew the numbers out of the water, at least on top line. And so they were forced to go back and raise their guidance for the full year, which I think was some of what contributed to this massive day that the stock saw. So kind of impressive. This is the first kind of foray into it, while the loss ratio is still in the 80s, not near the target of like low 70s. And we're still seeing these promising results. Just stands to reason that when they actually do expand over the next year or so into all the different states, I think there's going to be more upside there than a lot of analysts were banking on.
Yeah. And they're also trying harder to cross-sell now. So they sent me an email because this other email hadn't yet signed up for car insurance, and I had raised my hand to say I want to be on the wait list. Oh, so nice. I got an email from them encouraged me to looking into car insurance.
That's pretty exciting. Yeah, I still have not
for them to send an email, right?
Well, something they haven't even done yet. I signed up for car insurance maybe, I don't know, 3 or 4 years ago, something like that. And I've just never heard from them once. So I'm sure that it's coming. But to your point earlier, when the loss ratio is like 100%, it doesn't really make sense to lean in on marketing too much. It really makes a lot more sense to make sure you're getting your pricing figured out, get the core product to the right spot so that when it is time to lean into it, you can do so in a very profitable manner. So I think that's right at the spot we're in right now, which I'm excited about.
Ridiculous question, Matt.
All right.
Do you think Lemonade can grow to the size of Progressive, which is one of the leaders in car insurance? It's one of the first. They were the first to go big with telematics, but they're not using telematics to a high degree compared to Lemonade now.
Yeah, so Progressive, what is it, $150 billion market cap, something like that. Lemonade's at around 3 or 4, I think, something like that right now. And I'd encourage viewers who are not excited about insurance, go look at the all-time chart for Progressive. It's something like, 30,000% return all time, something like that. The chart is just insane. But let's look. So now we're not talking about the next 2-3 years. Obviously, we're talking about in the very long term. I think what Lemonade is trying to do is to structurally build an insurance company for the 21st century, meaning they should be best in class at pricing risk. They should be able to scoop the safest drivers from Progressive because of their use of telematics, and from Geico and all these other insurance companies, by offering a lower rate to those safer drivers than Progressive could offer them. And so that gets to the scale where over a long enough time horizon, let's just say 20 years to be long-term thinkers here, they should be able to be at a revenue line like approximately the size of Progressive today, maybe even higher. But we also mentioned that they're in all those other product lines. So really it's Progressive plus all these other product lines. But then on top of that, the thing that they have that Progressive does not is an in-house built AI substrate that is going to enable them to have this operating leverage that Progressive doesn't have. You're not going to have agents in all 50 states and brick and mortar offices and these commissions that go into perpetuity for agents. So what that all translates to is best in class, or lowest operating expenses for companies of a similar size. And so putting all that together, they'll have revenues that are Progressive size or higher in the very long term, assuming the company executes, and with margins that are like massively better than Progressive's today. I don't want to get too kind of like hyperbolic or whatever, because we're really talking about like the 20-year overall plan. But if they continue to execute and build what they say they're going to build, then it actually stands to reason that they could be worth significantly more than Progressive, because they're operating in more areas and they are able to do so at much greater margins. So yeah, I actually think I'm not saying this will happen, because any company kind of 100xing is improbable. So I don't want to say for sure that's going to happen, but there's nothing in their execution that I've seen so far that makes me think that's not a possibility.
Today gave us a lot of confidence. So we were wondering about car insurance, which was a pretty big piece of that 9-year, 10-year plan they showed us at Investor Day. I think it's $4 billion out of $10 billion in in-force premium or more was car insurance. Is that right, Matt?
The number I had in my mind was 6, but that actually, as soon as I had that in my head, I was like, that sounds a little too high. But let's say 4 to 6, somewhere in there.
So for this to finally get started and to get started profitably is incredibly exciting for us. Also, we were wondering if they'd be able to grow the European business. It didn't really seem like they were spending much money there. And lo and behold, they've tripled the European business in a year. Things are moving along and our thesis is being proven.
Yeah, it's nice to see. There still is incredible short interest out there. I think it was 31% last I saw.
Yeah.
So like short squeeze, definitely not part of our core thesis for investing by any stretch. We're not traders trying to take advantage of that. But I think it's an important thing to keep in mind that if we get this moment of capitulation like Tesla had in 2020, there is definitely the potential for fireworks.
And again, you mean upside capitulation?
Upside capitulation, yes. Where the shorts capitulate. Yeah.
Yeah, and when shorts capitulate, that means they're forced to buy the stock. I'm not sure how many shorts are aware that they're short Lemonade and they might have a basket of a bunch of companies. But for the shorts who are specifically knowingly shorting Lemonade as an individual stock, this was also thesis breaking.
So
yeah.
Along those lines, this is a bit of an anecdote, but I think it's telling. The Lemonade community has some pretty, I think, good-natured debates with some bears. I think the most vocal, most intelligent of those bears is a guy named Nick Lamperetti, I think is his last name. He's had very thoughtful critiques of why Lemonade is overvalued and why it's just not investable, all these things. And to his credit, gives some pretty thoughtful things. I think he's flat out wrong on most of it, but he at least has his point of view and seems to be fairly reasonable. Works in the insurance industry, so he's familiar with this space. He's been a perma bear.
He's an agent, I think, so he's threatened by what Lemonade's doing because they're not using human agents.
He's been a perma bear for a very long time. Today he posted something to the effect of it was nice, time to sell some covered calls after this implied volatility. Ooh. So people were wait, you've got to have 100 shares to sell covered calls. And he's yeah, obviously. So he's got to have at least 200 shares. So for a perma bear like that to have kind of not only capitulated and closed a short, which I think he was never actually short, but to flip quietly, I think is interesting. And I think some of these people who are short, or these funds that are short, see these trends just to if we can pull them back up here, it's pretty clear to see like where these trends are going. And if you want to be short this stock, well, these like really fundamental KPIs are all going in exactly the right operation. This is not projections. This is historical results. I think the clock is ticking on when you can be exiting your short position before it just becomes clear that this is a company that maybe it takes a long time to get to the price to book ratio that the bears would like, but clearly these are going to be trending in the right direction.
Pull that up one more time. So if you're short Tesla, you can look at the financials, you can look at the operating expenses and subtract the marketing cost. You can hear the story Lemonade tells all the time about them profitably acquiring customers. So like when they spend that $100 to get $300 in lifetime value, it's you can take it to the bank, but they've also shown it over a number of quarters, and their gross profits are undeniable now. So this is exactly what you want to see in a business to own, to be an owner of. Expenses are going down, gross profits are going up. This is a great thing. And most businesses, as gross profits are going up, I would say, I don't know, I'll be a little extreme here, Matt, but I would say 95% of businesses where their gross profits going up, their expenses are going up as well.
Oh, for sure. And a lot of times, like I've been analyzing a lot of companies where the operating expenses are like roughly growing at the same rate as your revenue, which can be a little bit of a worrying trend. And to be fair, like a lot of this growth is actually fueled by marketing spend, which is stripped out from the operating expense line. We do need to at least be clear that this is not just like pure like natural growth that the company's not paying for. They are paying for it.
Yeah.
But when you look at like their core, like what does it cost to service their customer base, you want to be looking at operating expense minus growth spend for that. And what they've been able to do on that front, I think is like honestly remarkable. And I would almost, somebody posted today and I completely agree. Like I would almost be like suspicious of fraud if I hadn't been studying this company for so long, because what they've been able to do, how they've been able to squeeze so much blood out of the stone of their kind of existing operating expense base is like really remarkable. But you have to go and actually talk to Adina, who's leading a lot of these efforts to make their back office extremely lean, and like just like how passionate she is about pushing the ball on AI and like using AI to make each employee like way more efficient.
Yeah.
I mean, it was just like, what was it, like a year or 2 years ago? We got really excited about them like sending automated emails, and that seems so quaint now. But like they did that, they rolled with it, they're using it more, and then they're on to the next thing. They're doing Loco and everything else. So they have this culture. And I think, frankly, they have excellent employees, and that's how they're able to achieve these results that they've got. So
we are Loco for Lemonade. We're long the stock. Our clients are long the stock. We are just under 1% owner of the company. We don't mind it when the stock goes up. We believe the stock's worth a lot more, but there may be some opportunities to trade the stock over time. Matt, we've trimmed Lemonade in the past. What are your thoughts about Lemonade here? I'm putting you on the spot.
Yeah, you are. This is a bit of a fundamental beat here. I think what we had last year when the stock went from, I don't know, was it 17 to 54 in a month and a half?
Yeah.
It was like a kind of nice beat, and it coincided with Investor Day. So frankly, the stock never should have been as low as it was in that sub $20 range. So I think there was a bit of a catch up at that point, but there wasn't really anything like significantly fundamental. This, I think the real fundamental difference, like that I'm going to have to go back and update my model, is just how significant this car opportunity is. I think we were hesitant to give them too much credit for car because it hasn't been proven out yet. The loss ratios, frankly, hadn't been where they wanted to be. The ramp seemed to go a little slower than you and I were hoping, at least earlier in this year. So
yeah, I thought they would get going in the fourth quarter of last year because they're excited about it and they're a tech company. Then it was also slow in the first quarter, so we were wondering what's going on.
Yeah, I think we dialed back our own assumptions on how this would go because it was just frankly taking longer than we were expecting.
Yeah.
Now we've got like real, like actual proof that, okay, actually it's really going extremely well. Yeah. Our model is definitely going to be improving in the short term in terms of the numbers that we're expecting to see. Definitely profitability. I think I had that in late 27. That's definitely going to be early 27 now. So all, and then on top of that, we didn't even speak about this, but the reinsurance, I think maybe we spoke about it a month ago or so. The reinsurance going from 55% to 20% is going to increase the amount of revenue that they're recognizing, and modest increase in their margins as well. And they shared in their note today that they're able to do that without changing their capital plan because their business is so profitable, which that was actually very surprising to me. I thought it was just a risky move to be reducing your reliance on reinsurance so much, but actually they're just saying, no, business as usual. We're not really increasing our risk of a capital raise in any meaningful way. They also highlighted that on the call, that they're being extremely selective around not insuring heavily in California or in hurricane prone areas like Florida, for example. So the risk that some hurricane is going to come through and blow out their balance sheet and they're going to have to capital raise is quite small now because of how well they've managed this risk.
So pour us some lemonade.